One of the other notable aspects of previous month was US lost its last AAA rating, while when Moody's also downgraded US sovereign rating from AAA negative outlook to AA1 stable, which is broadly in line with the AA plus ratings of S&P and Fitch as well. Um, so mind you, uh, and we will discuss it later on, when S&P and Fitch had downgraded the US ratings on again on worsening fiscal policy, on too much of gridlock, on improving the sustainability of US debt dynamics, the market had not really reacted materially. But if you look at this particular rating downgrade, this was taken quite seriously by the market. If you see the amber chart, which is on the left hand side, which denotes the US 30-year, it crossed 5%. And even if you look at the US 10-year, it moved from about 4.1 to 4.5% and now stabilizing at 4.4 at the month end. But broadly, the downgrade was taken quite seriously by the market because it doesn't just reflect a temporary debt worsening situation. But if you look at an overall macro imbalance in the US, and if you look at the chart on the right hand side, which signifies the US budget deficit as a percentage of GDP, as we can see, since 2000, 18, 19 onwards, the US fiscal balance has been worsening. Of course, during COVID, it really went all the way till 15%, but it hasn't really consolidated back to its pre-COVID trend of around 3%. It's still at around 7% as of calendar year 2024. Even if you look at going forward, it remains to be in up of 6%. So overall, the rating agency has called out that it's the debt dynamics of the US in question. Secondly, even the budgetary bill, which is proposed to be passed, by the House and the Senate, which the president has called a big beautiful bill, even that's pushing the fiscal deficit close to 7% because it will also be extending some tax cuts which the president had proposed in his first term in 2017. So there will be income tax as well as corporate tax cuts in the bill, which will again make some of them permanent, and broadly it will become very difficult for US fiscal deficit to come back to its pre-pandemic trend rate. So if we move to the next slide, as you can see on the left hand chart, and there's a line during 2011-12 which shows the rating downgrade by S&P. And if you look at after 2003-24, there's again a line chart which shows the rating downgrade by Fitch. And if you look at the first rating downgrade, interestingly, US 10-year actually rallied after the first downgrade by S&P. And if you look at the dollar index, that actually rose after the downgrade. The reason was that downgrade was coming in a back of huge global uncertainty, especially in Europe, at the time when Europe was grappling with the Greek and the Portuguese debt crisis. So there was a overall assessment that probably it will be very difficult overall for the world to really come out of the debt crisis. So not only the US but other economies will also face sovereign challenges. And despite a US rating downgrade, the financial market treated like any other event. And in fact, they saw that rating downgrade that if the US is not safe, probably the other countries are also in trouble. And they so in fact the dollar rose up in the safe haven demand. But if you look at the current downgrade by Moody's, it's totally changed the equation. Why? Because if you look at the chart on the right hand side, which signifies US net international investment position. So net international investment position is basically the balance between the assets held by Americans abroad compared to the assets which are held by foreigners in the US. So all the assets put together, whether it's equity, real estate, fixed income, central banks, or any other entity which is put together. So if we can see since 2006, they have been consistently on a declining path as a percentage of GDP. So all that was fine so far. But what US is trying to do under the new administration, it is trying to reduce its current account deficit. So what really US was doing right now, it was running a current account deficit for the rest of the world. And with the rest of the world, so broadly, the rest of the world was earning in dollars, and the rest of the world was deploying that dollars back into the US. So as now US tries to reduce the current account deficit with the rest of the world, what that means is the rest of the world will earn less dollars, and hence it will have less dollars to invest in the US incrementally. We still don't think that there is a major shift in investment strategy as things stand today, but going forward, as the US has kind of indicated to the world that we want to reduce trade with you, and as global trade reduces, that broadly means that on a net basis, dollar earnings for rest of the world economies will reduce, and hence their incremental investment in the US will also reduce. And at the same time, US fiscal deficit is increasing, and that means more duration supply, more dollar debt supply. So at the same time, when your dollar debt supply is increasing, you are shrinking the base for your natural buyers. So that leads to a certain demand supply balance, and that is why at this rating downgrade, this time market really uh, you know paid some attention to the downgrade, and hence we saw both dollar index declining as well as US treasuries declining as well. So we'll have to really watch out for how the US fiscal negotiations take place, on how whether US is really able to successfully demonstrate a meaningful fiscal consolidation model, and probably at that point of time we should see some pullback in US Treasury yields as well as dollar index compared to other currencies as well.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.